On behalf of our team at HBK, I'd like to welcome you to Specialty Valuations, Cannabis, Dealerships, and Fraud and Forensics. Our session is scheduled for 1 hour and is being recorded. Please note that all attendees are set up in listen-only mode. If you'd like to submit a question to our panel, please use the question box in the GoToWebinar control bar. If you'd like to receive CPE or CLE credit, you must stay in the session for the full hour and complete the polling questions. A certificate will be sent to you if you answer the polling question requesting one. A copy of the presentation materials is available for download in the handout section of the GoToWebinar control bar. At the end of the session, you'll be prompted to complete a survey and provide us with feedback on the presentation. For more information and insights, please visit our valuation website at hbkvg.com/insights. At this time, I'd like to turn it over to Stacy.
Good afternoon, everyone. I'm Stacy Udell. I am principal in the Valuation Group in the Mid-Atlantic region. I'm primarily out of our Cherry Hill office, and I'm going to start with valuing a cannabis business, because a lot of us are seeing in our states that cannabis is becoming legalized for either medical and or adult use purposes, but it's valuing cannabis business isn't the same as valuing other businesses for a lot of reasons we're going to discuss in this seminar today. So the slide says here, fundamental appraisal concepts still apply. So what that means is we have different standards of value and premises of value and approaches and methods. Those methods and premises and standards are the same whether I'm valuing a cannabis business or I'm valuing any other business. A standard of value is fair market value, fair value, investment value, strategic value. It's the way you're valuing the business. So if you're valuing a business for estate and gift tax purposes, it's different than valuing a business for divorce purposes in New Jersey, where the standard of value is fair value. The premise of value refers to when the business is operating, whether it's being valued as a going concern business that's still going to continue to operate, or whether it's being valued in the liquidation premise of value, which means the business is going to be liquidated, whether it be orderly or fixed. Orderly or having a brain freeze here, must be COVID, whether it's orderly or a fire sale. Valuations methods and approaches that we use there's income, asset, and market approaches to valuation. The asset approach is used when, generally speaking, when the business holds a lot of assets. It's asset intensive, and the value of the business is mostly attributed to the actual assets. We find that in holding companies a lot, family limited partnerships, holding real estate, stocks, things like that. The income approaches, there's two of those. There's the capitalized cash flow method, a capitalized and discounted earnings method. And those are used when based on the business's income. The capitalized cash flow method is used if the business's future earnings are expected to be stable, or the past is indicative of the future. In the discounted cash flow method, we recognize that there are going to be ups and downs. Things are not going to necessarily be the same in the past as they were in the present. And it enables us to look forward for the next year, 2, 3, 4, 5, however many, and we determine the cash flow to that point, and we bring it back to its present value, and we take this discrete period, and we also then you stop when things become stable, and then you take the present value of those the earnings from the point the business is stable on forward. In the market approaches, there are two primary methods. The comparable transactions method is when you compare other transactions in similar lines of business or which have similar factors impacting the business to your subject company. And you use the multiples from these other transactions and apply them to your transaction. The guideline public company method uses public companies in your industry and takes multiples from the public companies and apply them to your company. And then the issues that we face with these methods are the same, like whether it's a cannabis business or it's not. Can you go to the next slide, please? So, poll question number 1. Start with that real fast. Do you need CPE or CLE credit? Okay, so in the cannabis industry, these are some of the difficulties in the industry which make using the methods we just talked about difficult. And I'm going to jump back for 1 second, but you don't have to, the slide doesn't have to go back. I'm just going to talk about those methods for a minute. One of the things we find in the public company method is, especially in the cannabis industry, is that right now the public companies are so volatile, and there are transactions in public companies that, again, which brings us back to the comparable transactions method, that are based on the expectation of future earnings, because a lot of these cannabis businesses, when just starting, don't have earnings or cash flow from the beginning. But the larger multi-state operators often try to get it into other states and will make an acquisition to get into those states. I said, before, when talking to people, when working on valuations in this area, that it's interesting now, because a lot of what we do to come up with the value with an income approach, that doesn't mean for valuation purposes that's what the transaction will occur at. Most in the cannabis industry, people just want to get in. The industry's hot, so they're multiples that public companies are spending to buy other companies, or not even public companies. Other large companies are paying, overstated multiples because they're trying to get into the cannabis industry. So what makes it different, and why you can't, why Debbie or Rhonda wouldn't necessarily go and value a cannabis business right now? Because the market is different for wherever state or jurisdiction the business is located in, and that has to be taken into account more so than with a non-cannabis business, because regulations are different in each city. Different cities allow medical use establishments. Some don't. Some allow retail establishments, others do not. It could be that one town allows it, but there's not your town might allow it, and there might not be another business for 30, 40 miles. So all those things are going to impact a business's performance. For if you have a grower of cannabis, they're limited by their capacity often. So there's different things affecting cannabis businesses that we don't worry about with other businesses. Banking and access to capital are one of the biggest obstacles in the cannabis industry, because it's not federally legal. Many banks will not bank cannabis businesses because there's a lot of reporting requirements that they have in order to comply with the Bank Secrecy Act, and they don't want to expend the time that's required to make sure that their businesses are in compliance because they're serving cannabis businesses. So due to that, there's a lot of difficulty finding banks. I would say there's a handful of banks in New Jersey that will bank cannabis clients. And unfortunately, that means there's a lot of cash involved, so there's a lot of risks involved for both, for the employees of these stores. I mean, and even for the townships, because, if somebody's water bill needs to be paid, the cannabis business might be coming in with cash because that's all that they have. Finding qualified employees, not everybody, wants to be in the cannabis industry, and not a lot of people have, experience in the cannabis industry on the East Coast. So all these things, are impact businesses. The regulatory environment, New Jersey voted for adult use legalization. Pennsylvania is not yet. Ohio is not yet. But these things are all, possibilities. So all that has to be considered in the valuation on, what's their stance legally, what are the states around them doing, etc. Okay, next slide, please. So in an income approach, I mentioned before that what we do is we take the present value of the expected future cash flows. And we get to the present value by using a rate of return. And the formula for that rate of return is right here. And it's the equity risk premium, size premium, and risk-free rate are based on empirical data that is applicable for a specific day. On top of that, we add specific company risk, and that's where you capture the risk of your specific business and including your specific industry in this case. Because of the risk, those things we talked about previously, and the uncertainty in the industry, specific company risk is often very high. It can be as high as 30 or 40%. So you could, and when you increase the risk, you're increasing the rate of return, which is going to lower the value. So you will often find, cannabis businesses' risk-free rate of return to be significantly greater than another business that's, more stable and doesn't have these types of risks. Next slide, please. And some of the difficulty with when we use this method, we're often use a discounted cash flow method because let's say for a cultivator, for example, it takes time to get up to be at full capacity. So we have to take into account that the business isn't going to be at full capacity for however long it takes to become operational. We also, if they have the potential for expansion, things like that. So there's a lot involved in working on these cannabis projections for the discounted cash flow method. And these projections are also used just for determining how much money that a business might need to raise. But again, they're based on different things than if I was doing an operating business. So, those are just some of the details that we get into that we don't dig as much into it in non-cannabis businesses, but we have to when we're doing the cannabis businesses, because it's not like opening a door and you're going full throttle the next day. And it's not that the regulations aren't going to change, and that could change a lot about the way your business is run. If banking becomes legal tomorrow, that's going to impact the value of cannabis businesses because they'll have a lot more access to capital. They'll have access to banking. They're not going, they won't need as much, security. Their bank charges won't be as high, but then they'll have credit card fees, which they can't use now. So all these, different things that we take for granted with a non-cannabis business are very important when we're dealing with cannabis businesses. So when I take in 15 minutes, so I am going to now pass the baton Oh, well, I'll read the question here, and then I will pass the baton. So, have you planned a vacation for this year?
Hello, my name is Rhonda Sifra. I'm a senior manager in HBK Valuation Group, and I work out of the Youngstown, Ohio office. I was asked to speak about dealerships today, and as you see on your slide there, it includes a variety of different dealerships: auto dealerships, agriculture, construction and forestry, outdoor power equipment or OPE, recreational, and heavy truck. Today, we're going to focus on auto dealerships, as you can see by the graphic there, what's happening in the industry and what makes valuing an auto dealership different from other business entities. Next slide, please. So in preparing for this, I did a little research on the dealership industry, and it's definitely a good time to be a dealer. Retail sales, compared with where they've been in 2010 through 2020. During that time period, they basically ranged from 50 billion to 90 billion. April 2020 was the low point with sales of 50 billion, and they hit 107 billion for the industry in March of 2021. And October 2021, they were still high at 90 billion. And for autos and light truck sales, typically the number of units sold per month has ranged from 13 million to 18 million. And again, with COVID and shutdowns and everything, the low point was in April 2020 at 8.6 million and over 18 million in April 2021. And in November 2021, we were just under 13 million. So one thing that I found really interesting and what's been driving the industry a lot right now is the ratio of the dollars in auto inventory compared with sales. And typically that ranged between 2 and 3. In April 2020, it was almost 4. So there was the dollars of cars in inventory was almost 4 times what was being sold. And that completely turned upside down by November of 2021. And in that case, there's sales are like 4 times almost what the value is in inventory. So obviously there's limited supply, and demand hasn't changed too much. So the public dealership entities, I went back and looked at how they've been performing over the last 3 years, and their compound average growth rate, or excuse me, compound annual growth rate in the price per share has been 43%. And they're in the market and making acquisitions. There's a lot of buy-sell activity going on based on the publications that I'll reference later. And like I said, it's a good time to be a dealer. Next slide, please. So like Stacy said, when we do valuations, we consider all 3 approaches: an asset, an income, and a market approach. And in the case of dealerships, we're using a hybrid mix to capture the uniqueness of that industry. As you can imagine, it's a very asset-intensive business where you have an investment in inventory, in your machinery and equipment that are in your service departments to be able to repair vehicles and so on. So we want to be able to capture that investment that is required in the dealership. But in addition to that, it's worth more than just the hard tangible assets. There's a blue sky component, which we can get to that using a market or an income approach to have an idea of what the total dealership value is worth. And next slide, please. So what is blue sky? And that's a term that's pretty unique to the dealership industry. There's a few definitions listed up there. Some of them are more descriptive than others. Basically, it's the fair market value of the dealership over the fair market value of the tangible assets. If you look at other businesses, you'll often hear it referred to as goodwill. And the next definition is one that I like to use and that I'll address in reports and so on when I value dealerships, because it's an intangible value that's specific to that dealership, and it differentiates it from other dealerships that sell homogeneous or substitute vehicles. So if you think about it, a dealership, if you're buying a Toyota, you might have an option of 2 or 3 different dealerships within a reasonable drive of where you're located. What makes you pick one over the other? Because you can basically get the same vehicle from either place. So that would be a differentiating characteristic that would be captured in the blue sky value. And when dealerships are bought and sold, it's that blue sky component that is negotiated. Basically, whatever your net asset value is on your books as far as inventory, net of your floor plan, your hard assets that you're using in your shop, those are going to be what they are. It's that blue sky component that's going to differentiate the dealership. Next slide, please. So how do we value blue sky? The market approaches that we typically see would rely on subscription databases, but for dealerships, those are very limited and there's not a lot of comparability there. We could do a guideline public company search, and there are some public dealerships, but they're really not comparable. They're so much larger in size and diversity. They may own hundreds of dealerships. And how do you compare that with one single point dealer or maybe a dealer that owns just a couple dealerships? So alternative sources that we look at, there's a blue sky report that's published quarterly by Kerrigan Advisors and a Hague report that's published by Hague Partners, also quarterly. And those provide multiples of pre-tax earnings for dealerships. They're based on transactions that either of those companies have participated in, and they involve large private or public dealerships, so they're not directly comparable, but it does help give us a starting point. Furthermore, the dealerships that are included there are typically located in coastal areas. If you can think of the United States sort of as a smile from California, Texas, Florida, and then up the East Coast, whereas a lot of the dealerships we see are in flyover country. You know, Pennsylvania and Ohio aren't on coastal areas where they'd have the same opportunity or population as other areas. And the other thing worth noting about these publications is they represent buyers and sellers. So there's a marketing spin to the work they publish as well. But it's something that is available and relevant for the industry and that we can consider. Another approach would be the income approach. And here we would look at what type of risk factors pertain to that blue sky value that we're trying to get to, and what type of required return would that buyer want. We can develop a capitalization rate and convert it into a multiple. They're basically two sides of the same coin. Or we can capitalize normalized earnings to get to a blue sky value. In looking at that, we're relying upon historical normalized net income as a proxy for the future. We'll have discussions with the dealer and see, what's changed. If they've made an acquisition or a major improvement, maybe there's some years that are more relevant than others. So there's things to consider there. I've seen both market and income approaches used, and the important thing is for it to make sense when you're done. And there's also some brands that don't have published multiples, so it's good to be able to have both tools available. Next slide, please. So how do we adjust multiples or estimate risk and return? Historical performance is a key point. What's the size of the dealership? Does it have growth potential? Manufacturers publish various metrics and reports that they issue to their dealers. Basically, each dealer is assigned an area of responsibility. How do they perform in that area? That's their target market. And what kind of survey information do they get back from customers that are buying cars there or seeking service at the dealership? And that would give you some indication of how they're performing in the public size and what opportunities might be there to improve. Another factor is operations and expense absorption and controlling cost. The back-end departments of service, parts, and body are the ones that you want to be able to cover your fixed cost. So if those aren't operating efficiently, there's an opportunity there for someone to buy the dealership or to increase its value by improving that performance. Is the dealership profitable? And what does their balance sheet look like in terms of liquidity, leverage, and working capital requirements? All dealers have a certain amount of floor plan, which are loans that they take out to fund the acquisition of inventory, and then they pay them off when the inventory is sold. But is there other leverage out there? Are they meeting their working capital requirements, which are stipulated by the manufacturer? Where are they located? What's their market look like? What kind of competition do they have? I worked on one recently where I think it was a Mazda dealership where they were the only Mazda dealership authorized in that market. Well, that gives them an advantage over, because they are the only one. There's no alternatives there for a customer to go buy that brand if they wanted to. And that lowers the risk. What does the regional and local economy look like? Is it growing or is it declining? What's the employment look like? In certain parts of the country, you wouldn't want to locate a Mercedes dealership if the people in that area are typically going to be buying non-luxury vehicles. So there's things to consider there. Management. It's one of the requirements for a dealership is to have experienced management. Having stability of that management over a number of years and consistent performance is a key factor and something that would reduce the risk and make the dealership worth more. And one thing that's interesting that I see a lot in dealerships are they seem to be in family groups. If you travel, very often you'll see a dealership commercial on TV with maybe the same person speaking that you saw in your home state, because once a family is established in that industry, they seem to get approved for more dealerships. So that's one thing that's interesting there. Community involvement, how well they're recognized and respected in the community, that can all drive blue sky value and drive customers to the store. A key factor is facility compliance. All the manufacturers have standards that they want their buildings to represent. And if they are not meeting them, they're going to want you to spend money to improve them. So that's another factor there. They can be very picky in some instances. I've heard one story of a manufacturer not being happy where the TV was placed in the customer waiting lounge. The manufacturer or the flag that they're flying is another indication of demand for that brand, or how it's viewed in the public's eyes. That you're going to pay a higher multiple for a Porsche dealership than you would a Kia dealership. You know, there's luxury brands and there's non-luxury brands, and even within each of those categories, there's some variety. In a non-luxury, you know, you have Toyota and Honda at the high end, and Mazda and Nissan would be at the low end. And same in luxury, even they classify Cadillac and Lincoln in the luxury category, but they're way at the low end. And in pricing a dealership, you would look at the upside potential. What's the opportunity there? Like I mentioned before, if they're not covering their fixed cost, how can somebody come in and turn that around and improve operations? So if there's opportunity there, it's going to increase your chance of getting a higher return. Next slide, please. Okay, this lists some common adjustments that we make to dealer statements. It's not unique to dealers, but 13th period adjustments are quite common. Excuse me. And what that is everyone's used to there being 12 months in the year, and someone can close the year, but there's year-end adjustments, and there's a separate period there where those could be booked and then dealer statements produced. Well, some dealers may book those to retained earnings in the subsequent year instead of recognizing all the expenses in the 12th period. So that's something to look for and adjust for, because you don't want to be shifting earnings from the period where they should be recognized and into a different one. And LIFO, which is last in, first out, is the inventory valuation method most dealers use. And in doing that, they have their inventory on the books at the current cost, but there's a reserve there, the LIFO reserve, which is reducing it to older costs. So in that case, there's a reserve there. They're recognizing expense and building that LIFO reserve. So you want to look at that change in the reserve each year, because that, again, would be profit. If they're building inventory and there's inflation, there would be profit there that isn't recognized in the year where it belongs. And when we look at the balance sheet, we look for adjustments to get to the fair market value of the assets on that balance sheet to apply the asset approach component of that. And doing that, we eliminate that reserve, because you want to reflect the inventory at what is closest to its current value. And by eliminating that reserve, you would trigger a tax liability. So we accrue for that also. And used inventory often has write-downs. If someone brings in a car on trade, very often, if it sits there for a while, it's going to depreciate in value. This year is unique in that used inventory is basically holding its value, if not increasing in some cases. So most dealers are not making write-downs. Fixed assets and depreciation adjustments, again, depending on how you're depreciating your assets, a dealership has to have a certain minimal amount of equipment and assets on hand to be able to run. So even if they've depreciated everything, there's still value to those assets. They're still in service and they're still productive, so there needs to be an adjustment there. Obviously, any personal assets that you have need to come off the balance sheet. Chargebacks, that's a unique thing for dealerships where if someone is selling vehicle service contracts and they wreck their car or sell it early and there's still premiums due, then that insurance company is going to charge back the dealership for those premiums that weren't realized. Related party activity, we need to look at officers and family members. How are they compensated? Is it in line with market? Same with rent. Most dealerships, the real estate typically isn't owned in the dealership, but in a related entity, so you can have people manipulating the lease rate there. Charitable contributions, PACs, that's something unique to dealerships where they're adding value to cars and baking in some profit there. They could be allocating marketing or overhead expense, dealer prep if they're washing the car or doing anything to improve upon it from how it was delivered from the manufacturer. They can put that value into their inventory and they record a liability for it. Some dealers will adjust that monthly or quarterly or annually to make sure whatever packs are in inventory on new or used cars balances out with the liability. Other dealers don't, and in that case, they might be building up this liability account, which I've heard referred to as a bruise account, and it's basically shifting profit, and that needs to be recognized in the year that it should have been in order to get an accurate view of the profitability of the dealership. Over remits, that relates to reinsurance companies, which the finance and insurance products that dealers sell. They can increase the amount that's remitted to the insurance company, and very often what will happen is that flows back through and it goes to the dealer personally at times, where it may even be sent to their house directly, but it is a function of the dealership. So if we're valuing a controlling interest where someone would have access to that, it needs to be included. If it's a minority interest, usually we're not going to be including that. Personal and non-operating expenses and non-recurring income and expense items, those are similar to any valuation when we look at something unusual like that. Next slide, please. So some additional considerations, is the dealership reporting losses? If they are losing money, is a buyer going to pay for them? Is there a value to it? And the answer is yes, because that sales and service agreement still has value. That's what the dealer's looking for, is that opportunity to run the dealership. And you could see a higher blue sky multiple if the earnings are depressed, because your denominator is going to be lower, so it's going to increase that multiple. So a buyer will pay for the chance to improve earnings. What kind of trends are we seeing? Right now, dealerships are doing great. Is it sustainable? I don't think, from what I've seen in 2021, that we'll see performance at those levels stay the same, and I'm hearing that it won't, that most dealers expect it to trend back down to where it was before COVID. What significant changes have been made in operations? You know, I've heard of one dealer that had an assessment of their operations done, and they scaled back some personnel and improved those back-end operations, and they're operating more profitably than they were before, and they don't plan on going back. So those earlier years, we really wouldn't consider. Are they meeting working capital requirements? And these are established by the manufacturer. And Sometimes if they need to strengthen their balance sheet, the dealer will make a loan to provide that capital. And if they don't meet working capital requirements, they can risk termination of their sales and service agreement, which is one of the unique things about dealerships is the manufacturer has a lot more control over it than other businesses. And as I say there, the manufacturer owns the brand. The dealer owns the right to sell and service the vehicles. So if you don't meet those requirements, you can risk having your agreement terminated, or they'll receive letters that put them into a cure program where they're reporting more often and working with people to turn the dealership around. And that can happen if they're not meeting their retail sales goals, working capital. They want them to run the way they want them, the way they're desired to. The manufacturer approves all transfers. And a buyer has to meet certain criteria. And that's a huge factor in looking at marketability. Even if you have the money to buy a dealership, if you don't have experience or have somebody in your ownership group with the experience of running a dealership, you're not going to get approved. So that needs to be looked at also. And it can be contingent on agreeing to improve the facility. A manufacturer may overlook a facility that needs improvement if it's staying with the same owner for a little while, but if they want to approve a sale, they're going to make them spend the money to improve that. And so finally, take a step back and see if it makes sense. Does it make sense for the brand and for the performance of the dealership and the return that somebody can get by investing in it? Next slide, please. So we have another poll question. Have you made any New Year's resolutions? Yes or no? And I believe it now. I'll turn it over to Debbie, who's the last panelist. Thank you.
Good afternoon. My name is Debbie Feuster. I am a senior manager at Hillbarth and King Valuation Group. I have a physical office in the Erie and the Pittsburgh office. However, I also virtually work with offices in Ohio, Florida, and New Jersey when applicable. I'm often asked, what is forensic accounting? Some of the forensic services we provide at HBK VG are misappropriated asset analysis. This type of service is applied in areas of divorce, estate, employment, shareholder disputes, bankruptcy, and insurance claims. Generally, our procedures include a forensic audit. A forensic audit requires tracing of the transactions to determine the financial impact, if any. In the more complex cases, a report and schedules are prepared to support our findings. Testimony from an expert is sometimes required depending on the extent of the litigation. We also assist attorneys in settlement discussions if litigation is not the desired outcome. Next slide, please. Embezzlement cases are a prime example of occupational fraud. The Association of Certified Fraud Examiners define occupational fraud as the use of one's occupation for personal enrichment through the deliberate misuse or misapplication of the employing organization's resources or assets. Next slide, please. Misappropriation of assets is a type of fraud. Fraud is like the proverbial iceberg. The deceptive nature of fraud means it is unknown until discovered. leading to potential submerged or unknown frauds beneath the surface. The theft of assets could be cash or tangible property, such as inventory. Trust is always a major factor in embezzlement cases. The lack of inquiry increases the risk of the mishandling of finances. Next slide, please. Manipulation of the accounting records is proof of the intent to hide the crime. 3 ways to divert assets from a company are skimming, larceny, and fraudulent disbursements. Next slide. Skimming is an off-book scheme, meaning that the sales are not reported, or if reported, then it is understated. Skimming is more difficult to trace, but not impossible. Skimming occurs most frequently in cash businesses such as bars. Financial analysis and industry comparisons are tools that can be applied in skimming transactions. Next slide, please. Larceny is the taking of cash after it has been recorded on the books and generally has an audit trail. The diversion of cash is without the consent and against the will of the owner. Comparison of accounting records and bank statements is a popular method of identifying red flags. Next slide, please. Fraudulent disbursements are the most common form of asset misappropriation. Fraudulent disbursements are traceable and generally easier to prove. Someone misuses their position for an inappropriate purpose. An audit trail exists. Some are more complicated than others. The best source of documents in this type of case is to request third-party documents from a bank or a credit card company. Developments in computer software programs make it easy for criminals to alter documents to cover up the dishonesty. And I would say probably half of the last few cases I've had has involved some kind of document that has been altered in some way. Next slide, please. For a charge of embezzlement to be supported, 4 factors must be present. There must be a fiduciary relationship between the 2 parties. That is, there must be a reliance by one party on the other. Second, the perpetrator must have acquired the property through the relationship. Third, the perpetrator must have taken ownership of the property or transferred the property to someone else. His or her actions were intentional. Next slide, please. Common characteristics of people who commit fraud have been identified as trusted. They have a skill to get people to believe and trust them. They are intelligent, inquisitive, egotistical, risk takers, rule breakers, hard worker, greedy, complainer, defensive, irritable. And just because somebody might fall into one of these characteristics doesn't mean that they will commit fraud, but one or more of these characteristics, you might need to look into it a little bit more. Next slide, please. Behavioral red flag examples are living beyond their means, big spender, close relationships with customer or vendor. They lied on their resume. They have legal or financial problems. They refuse to delegate. Divorce or family problems. Disgruntled. Addiction's key. The increase in gambling addiction has been relevant in a lot of the cases recently. Refuse to take vacation. Usually this is trying to hide the scheme that's going on. Unusual work schedule, comes in on weekends or at night. Intimidating subordinates, making other employees nervous about asking any questions. Next slide, please. The fraud triangle created by Donald Cressy is a well-known criminologist, and he outlines 3 specific factors: motivation or pressure. This represents the need for committing the fraud, such as the need for money, meet performance objective, or meet stakeholder expectations. We have seen an uptick in motivation-related cases to gambling addiction. Rationalization is the mindset the fraudster uses that justifies committing the fraud. Examples are, the company owes me. I'll pay the company back later. I'm not hurting anyone. Opportunity is the situation that enables the fraud to occur. Cressy believed that a trusted person may become a trust violator when there is an opportunity, motivation, and rationalization to do so. Next slide, please. A new methodology approach illustrates the psychology behind modern-day frauds. It is known as the fraud diamond. It begins with temptation, and that can be with or without pressure. The opportunity exists or can be created by the fraudster. A feeling of entitlement replaces the rationalization. The 4th element is boldness, the ability of the fraudster to act in a way that is considerably more courageous or more confident than the average person. Next slide, please. The fraud triangle approach has a few weaknesses. Cressy believes that a person who committed fraud was an honest person from the very beginning, and because of certain conditions, then they would commit a crime. New research has indicated that opportunities do not have to exist because the opportunities are created by the fraudster. The other flaw is that all people have a functioning consciousness, and that is not the case. Privacy protection makes it difficult to identify external pressure when employees embezzle funds. The fraud diamond incorporates the psychology of fraud. It examines human behavior and ethical decision making. Next slide, please. The fraud diamond has a lot of characteristics, personality traits that is also included in the fraud diamond. I'm going to only go over the ones that have not been discussed previously. They're flexible, they're innovative, they're charming, they're bold, they're assertive, discerning, persistent, witty, reinventive, business savvy, adaptable, manipulative, deceptive, and fearless. And again, just because one of these characteristics exists does not mean that this person is going to commit a crime or a financial crime. Next slide, please. Results from a research study of fraudsters indicates a fraudster's conscience may prohibit his or her moral compass from functioning correctly. The conscience is meant to warn a person when making a questionable decision prior to violating an internal boundary. Obviously, some of these people's consciences broke. A faulty moral compass is associated with an increase in belief of entitlement. External pressures are not generally obvious to employers or to internal auditors. So when, specifically in an embezzlement case, if somebody is having health issues and is in debt, or the family has someone who's very sick, an internal auditor or the employer may not be aware that this is going on and that there's a motivation to steal money to make ends meet. Next slide, please. Companies can take proactive steps to reduce the risk of becoming a victim. One common one is segregation of duties. It's not always possible because of the size of the organization, but if possible, segregations of duties is a top proactive step. Cleared checks, this can be through the bank statement or online access. Companies should be concise and consistent with their policies. A lot of the areas that I see are in expense, travel, credit card, and this also should disclose what actions would be taken if the policies are abused, so there's some type of accountability on record. Financial statements, the transparency is important. Management should ask questions. The statement should be on a frequent basis, monthly, and there should be accountability again if the controller or CEO does not provide the statements as requested. Next slide. Other areas where we can take proactive steps is through a criminal background check. That's not always a guarantee, especially I've seen quite a few of these embezzlers who make it a career, and they will get caught in one state and leave immediately and move to another state and start all over again. Bonding is helpful for the insurance money to pay for us to prepare the investigation and to recoup your loss from theft. Surveillance cameras in some situations will deter employees from stealing. Strong inventory tracking program, that's also industry specific. Original documents should be required all the time. There's too much, it's too easy now for employees to alter documents when they're submitting an expense report or providing receipts for a credit card. Next slide, please. Eliminate cash transactions if possible. Tone at the top. If the top is showing morals and ethics, then it's more likely that the staff will follow. Spot checking the accounting records periodically. Mandatory vacation. The board education is more in line with the nonprofits that I've worked on. Recently, they have higher risk of embezzlement because the board is not educated in finances, and they either don't make the treasurer accountable for presenting financial statements regularly, or they don't understand the financial statements in the first place. Dual signatures and no rubber stamps. Next slide. Go over a few quick statistics because we're getting close to the end of our time. The length of a fraud scheme is approximately 14 months. And that is from the time it starts till the time that someone discovers it. Asset misappropriation schemes are most common at 86%. The median loss is $100,000. The most common initial detection is through tips. 43% of the frauds that were surveyed were from a tip. Internal control weaknesses account for 1/3 of the fraud cases. Private company sector is 40% of the victim organizations. Public company sector is 26% of the victim organizations. Next slide, please. The length of occupational fraud is generally 2 years for fraudulent disbursements, unless for skimming. That would be 16 months, and cash larceny is 21 months. Thank you, and I'm going to turn it back over.
Okay, thank you very much. We have our last poll, and I will get that launched right now. Thank you everyone for attending today's webinar. If you have submitted a question, we will have follow-up with you via email on this, and you will get a copy of today's recording emailed to you in the next day or two. Thank you and have a great day.